Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, Canada's newest and possibly last pipeline is finally operating. So was it worth the wait? And housing starts aren't exactly soaring in Canada, but why not? Plus, our complicated relationship with tobacco. That's all ahead. First, for the week that was in business, it's time for the briefs. Anemic growth in Canada for February and expectations of a muted showing in March has some concluding interest rates could fall sooner rather than later. Combined with January's growth, it is expected that the economy expanded at a 2.5% pace in first quarter. Not bad for Canada, but slow enough to take the pressure off a central bank still worried about inflation. The U.S. Federal Reserve held rates steady this week, as expected, but the U.S. Central Bank signaled that it is still worried about persistent inflation and will keep rates where they are until things improve.
Readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate.
It was the opposite message heard from Canada's central bank governor this week. Tiff Macklem expressed optimism about inflation.
The short answer is we are getting closer. We are seeing what we need to see. We just need to see it for longer to be confident that progress towards price stability will be sustained.
More Canadians are waiting for mortgage costs to drop before buying a home. That's according to a survey by BMO. 72% of would-be buyers plan to wait, an increase of 4% from last year, as worries about the cost of living and inflation continue to rise. London drug stores across Western Canada were closed this week after a cyber attack on Sunday. While some pharmacy operations remained open on an emergency basis, phone lines were down and most stores closed due to security concerns. The closure affected 80 stores in total. Loblaw reported a 10% increase in profit in the most recent 3-month period, as sales rose just shy of 4.5%. The company said lower prices helped drive traffic. It coincides with a planned boycott of Loblaw by some shoppers for the month of May to protest the perception that it is profiting from inflation. Cannabis is close to being reclassified as a less dangerous substance by U.S. drug authorities. It's a move that opens the door for more legalization. Many states have already legalized cannabis, but federal law makes banking associated with it more complex. The reports sent shares of cannabis companies higher this week.
This is a huge moment for our industry and really for the sentiment change and the acknowledgement by the federal government that cannabis products do in fact have medicinal value.
And those are your business briefs. It was a big milestone this week when the expanded TMX pipeline began partial operation. The $34 billion project is 6 years behind schedule, but the importance of the first new pipeline in 70 years might be obvious, at least to its Western oil producers. Rory Johnston is founder of Commodity Context. Rory, thanks for being with us.
Thanks for having me.
So a long time coming, but can we call this a success? Now that it's up and running, do we expect it to be worthwhile?
I think absolutely. I think, first and foremost, despite what the government may or may not end up getting for this pipeline, I think the important thing to keep in mind is what it does for the Western Canadian oil industry and what a world would have looked like absent this pipeline if Ottawa didn't step in to build it. And that would have been a future where pipeline bottlenecks would be crushing at this point. There would be, I think, broad panic in the industry about how we're going to get our barrels to market. And now, like you said, we're going to have the first, big new pipeline in forever. And it's going to give us a jump forward in this egress or pipeline capacity availability for the industry. And that's going to mean better pricing. And I think even more importantly, a lower probability of these disastrous blowouts in differentials like we've seen over the past kind of decade.
And I want to hang on that because some people might be surprised that Western Canadian heavy oil trades at a big discount. We don't make as much money. It's not a barrel of oil to a barrel of oil. This heavy oil is what will go in this new expansion. We have a ready market in California. We have overseas markets. How important will that be? Might we actually make more money on every barrel of oil now that we have a way to get it to customers?
That's exactly right. So just to put in perspective some very, very basic numbers, the differential or discount that WCS, Western Canadian Select, our main heavy crude export barrel, trades relative to WTI, which is the price everyone usually talks about on TV, is normally in healthy times about $13 a barrel. And that reflects both the heavy nature of the crude and its distance from where it's consumed. But that differential, as recently as 2018, we had that differential blow to $50 a barrel. That was costing tens of billions of dollars to the industry. and billions of dollars to the Canadian and Alberta governments through lower taxes and lower royalties. This now, this dramatically reduces the probability of those blowouts. And as you note, we're going to have different customers in the Pacific market, rather, relative to more than 95% of our crude right now goes entirely to the United States. So that also creates flexibility and optionality, which is of value to these customers in these markets.
I got to ask you, this is not a political question. Let me stress, this is a practical question. Could this have been done with any other owner? It used to be in private hands. The government bought it. They spent a lot more than they expected, both on buying it and on finishing it. But was that the only way to get this pipeline built?
I think so. At the end of the day, if you look at, Kinder Morgan, the original owner of this pipeline, continued to win most of its court challenges and legal challenges. But the challenge was they kept coming. And the federal government has a different standing with the courts that allows it not to be stymied by things like provincial, lawsuits brought by the BC government. So I think, the federal government was, I think, the only one that could build it in this way. And a lot of people, I think, are reasonably critical of the fact that it went from, $7.5 billion expected to cost when they bought the thing to $34 billion now. Obviously, we had huge weather events in terms of the atmospheric river that caused huge flooding in the region. We had COVID. We had all this other stuff that dramatically inflated the cost. I think when we have a hearing in September with the Canadian Energy Regulator, we're going to get more information as to what the exact breakdown of those costs are and how reasonable they were in hindsight. But I think, yes, I think the federal government was the only one that was going to build this pipeline, which begs, a very natural and worrying question of where do we get the next pipeline after this? This obviously was part of a bundle of pipelines that took over a decade to try and get to fruition, and two of them fell off along the way. We lost Keystone XL and we lost Energy East along the way.
Right.
Now we have no pipelines in the pipeline of pipelines is empty. And what comes next?
That will be the question. Rory, great to have you with us. Appreciate your time.
Thank you.
Rory Johnston is the founder of Commodity Context. Coming up, there is a lot of talk about building more housing in this country, not as much action as you'd think. Stay with us.